All right, thank you guys all for joining us today. This is going to be recorded. One thing I say at the beginning of all of these webinars that I do is please watch this again as soon as you get an opportunity. The longer you wait to re-watch this, the less you're going to retain. So if you can watch it again rather shortly after it's sent to you and after watching this webinar, you will retain a lot more of this and won't have to take as many notes or refer back to your notes or even go back and rewatch it again at a later time. So one thing that helps, I find, is if you rewatch something again rather shortly after learning something new, that you will retain it more. Anyway, this is a webinar on short straddles with no upside risk. And one of the reasons why I wanted to do this webinar is because the short straddle is an option strategy that you can collect probably the most premium for. And the problem with it, though, is a short straddle doesn't allow you to implement this into an IRA. So this is a strategy that is IRA compatible. But get a few things out of the way before we move on. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for over 20 years now. I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to teach you how to take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. If you guys can take control of your own portfolio rather than having an advisor do it, you guys are going to end up doing just as well after just a little bit of education. At the end of the day, a lot of financial advisors, believe it or not, come from sales backgrounds, and those are the ones that do the best. So I don't know if you've ever even seen that commercial where the guy acts like a financial advisor and then is actually a DJ or something. That's really dependent on the personality, and all they have to do really is pass the Series 7 in order to take control of your finances. So a little bit of education goes a long way. And you guys are on your way to doing that for just joining in on this. But I've traded most markets throughout my career, from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products. And in most market conditions, as you can see down here. I do have a disclaimer I have to go over before we go further. Basically, this just goes over and says that any opinions, news, research, analysis, and prices, other information contained here or provided by ProTrader Strategies and or associated companies, employees is for general commentary and should not constitute investment advice or solicitation of any of these strategies or securities that we're going to be talking about. Some of these strategies or some of these securities that I'm going to be talking about, I actually have in my portfolio. I'm not doing this to try and get you guys to invest in the same stocks or underlyings that I'm investing in and get in the same directional bias that I have. Take your own opinion, take what we teach you here and implement it into your portfolios, but do that in your own way. And please remember, the past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way. This, like I said, this is on the short straddle with no upside risk, and I'm going to go into detail as to how you build out this strategy. It's actually relatively easy compared to some of the other strategies. This would be somewhat considered a more advanced strategy, but at the end of the day, it's really not that advanced at all. It's just creating the strikes so that you don't have the upside risk, and it makes it IRA compatible, which is important because a short straddle would not be IRA compatible because of your unlimited risk to the upside. IRAs, for some reason, they don't care about your downside risk because it can only go to zero, but you know, that is because people make laws that really don't understand what they're talking about, I guess. But that's just my little soapbox. And this strategy, we need to have an assumption that is going to be market neutral, or the underlying is going to trade sideways, trending sideways to bullish. Because we don't have any upside risk, we would much rather this trade to the upside than to really sell off to the downside, because our risk is to the downside in this strategy. And a short straddle, if you guys don't know, a short straddle is basically just selling the at-the-money put and selling the at-the-money call. And then we're going to buy this out-of-the-money call to define our risk for this short call. And I'm going to show you how to do this to where, like I said, you have no upside risk. And I took a couple of screenshots from yesterday. And can everybody see this okay? On mine, it looks like it might be a little cut off at the bottom, but I think you can probably see this okay. Just kind of let me know, and I'll try and figure something out to get that to work. But what we're doing at the money straddle, as you can see here, Apache is trading at $47.69. Now I picked the 48 strike on this particular one. Yes, the at the money is probably closer to these calls, but I was looking at Apache and wanted a little bit more room for the upside. So you can kind of play around with those two depending on your bias. If it's more to the down, or if you're a lot more worried about the downside, then you'd probably pick this 47.5 strike here. This market was rallying and then kind of came off when I decided to do this and was picking my strikes. But as you can see down here at the very bottom, that's where I sold the 48 put, and then right here is where I sold the 48 call, and then defined the risk on the 51.5 calls. And as you can see, my total credit was $3.73. Now, the easiest way to look at this is 48 to 51.5 is $3.50, right? So this credit that I've received has covered this distance between the 48 strike and the 51.5 strike, and leaving me about 23 cents on the upside. So in this regard, if it goes straight up after I implemented this strategy into my account, if it goes straight up, I would still collect that 23 cents for this strategy. So there is absolutely no risk to the upside, and I can actually profit with this strategy by having that 23 cents. If it trades up to 60 or whatever, I am out of this trade on the short calls at 51.5. Anything above 51.5, I get to keep that 23 cents extra. Does that make sense to everybody so far? How I get to keep that extra 23 cents? Okay, good. But to the downside, I'm going to start worrying about this at around 44.50-ish. 44.27 is really where my break even is on the downside, because I'm going to subtract this $3 credit from the 48 put here. Does that make sense? So 48 minus the 3.73 is where my break even is on this. Yes, I'm selling here the 40, as you can see, it sold 148 put right here, and up here I sold 148 call, and then define my risk, I'm buying the 51.5 call. So anything above 51.5, I keep the extra from the $3.50, which is 23 cents. So if this goes straight up, I get to keep that 23 cents. If it goes below the 44.27, then that's where my break even is on that, because you're subtracting the $3.73 from that 48 strike. I'm being asked, do I ever buy the out of the money? That would be if you buy the out of the money put to define that risk. Yes, that would be called an iron butterfly though. And if you're worried about this going to the downside, and it starts doing that on you, then by the time you're going and buying that extra put, it's really going to, that put that you're buying is going to be worth a lot more. So that makes it a little bit, it's going to make you kind of like locking in a loser for all intents and purposes, especially if it gets down to that strike where your break even is. You're going to be paying up a lot for that. So, yeah, it's going to be way too late. Exactly. I'm getting a question on butterfly. It would be the iron butterfly if you're doing calls and puts and you bought that out of the money put. That would create an iron butterfly, which I've done webinars on. So if you want to learn about the iron butterfly, we've done webinars on that too. So you can go back to Pro Trader Strategies and look at that one. Oh, you're making a reference to point of entry. Yes, then that would be the iron. You would be entering an iron butterfly. And if you are buying that out of the money put and creating a iron butterfly, your credit's not going to be as much, which is the nice thing about this one, is you can still collect a pretty nice premium for it. And it's kind of mimicking a short straddle in an IRA. And in an IRA, the only way you can implement a straddle is if you define the risk to the upside. For some reason, they don't care about you defining your risk to the downside. I guess because your risk is defined by it going to zero. But we would never really hold on to this strategy until it gets to that. And I will go over the max profit and loss later. But this is another example of this same strategy with LinkedIn. And again, we're selling the at the money call. This is trading at 111.92. So the closest to that is the 112 strike. So we're selling the call and selling the put. And then we define our risk by figuring out. So when I sell these two, right, I'm collecting the $3, and for math purposes, let's say the $3.70, and then I'm selling the $3.90. So I'm collecting an overall credit of $7.60. Then when I go out and buy this 18 call, I'm paying $1.50 for it, so that, or $1.50 something. So you subtract that out, and that's where you get your $6. So we're going to have to play around with these numbers because we know right off the bat we're selling the straddle. So that's where we start building the strategy out. We sell the straddle, we figure out what our total credit is, and then we have to play around with those numbers to figure out how far out we can go to make it equal to the distance in the strikes. Does that make sense? So in this regard, it fit that if I bought the dollar or the 118 calls, then that equaled out to be $6, which is equivalent to 112 to the 118, right? $6 difference. So again, I would collect 2 cents if this went straight up from after implementing this strategy. And in that regard, there's no risk to the upside. And then again, our break even to the downside would be subtracting this $6.02, excuse me, from the put, which would give you 106, right? So LinkedIn can trade down to 106 before we have to start worrying about this getting away from us. Because the regulators know that the markets don't correct with massive liquidity. Very true. Good one. Do they know that? I don't know. Sometimes I think we're smarter than them. But anyway, could be, beating on a hornet's nest, talking like that. So our max profit, anytime we're doing a credit, collecting a credit, our max profit is always that credit we received from the onset. So I don't leg in and out of these things. Yes, Frank Dodd, nobody there on the opposite side anymore. So or Dodd-Frank, sorry, you're right, Dodd-Frank. And, Gee, you could get me going on forever about all of that, from Glass-Steagall to now. But anyway, that's a whole webinar or forum in and of itself. But the max profit is always the credit we received on any of these strategies. And then our max loss is going to occur when the underlying goes to zero. But you guys, we're never going to let this go down to zero. And although LinkedIn could go to zero, it's highly unlikely. But what I usually do with this strategy is, if I'm collecting, $3 on this strategy, I'm going to cover it immediately as soon as it is at like 2 times the credit received. So I'm risking to make 1 in a sense. And then our break even, I think I've gone over this enough. It's our long put minus that credit received. So because we've defined that risk to the upside, we've talked about that. We don't have a break even to the upside necessarily, because we've defined our risk. And we obviously, I can talk about the probabilities and everything, and I will go into that. So if I kind of forget about it, there's always a probability of touch, and we would rather have our probability of touch move to the upside, which is why our bias needs to be somewhat bullish on this. We want our probabilities to happen where we get tested on the upper band rather than on the lower band, because that is our undefined side. So always have that in mind, where you want to have a little bit of upside potential. Oh, sorry. Yes, I did say, you know what? You're right. I did say short there, or it is short. I'm sorry. I don't know why I put long put. This is short. Got all red-faced now. Good thing you guys can't see me. I'm very embarrassed that I put long there. Short. Yes, it is your short put minus your credit received. Sorry about that, you guys. All right, I meant short put on that. Sorry for the confusion. That's our break even. Our short put, because we don't have a long put. So I did this. I wasn't able to analyze those trades after I put them in, and that it was a afterthought. So I went to another one. One caveat to this: we want high implied volatility percent, and I will go into that a little bit later. So it was pretty difficult to find high implied volatility percent underlyings that didn't have a binary event or an earnings coming up, and that had a lot of volume in them. So after I implemented those other 2 strategies that I did, and anytime I'm doing these webinars and I go over examples, I usually will implement these on the Monday after. I wanted to implement these before this webinar, just because I was a little bit worried about implied volatility coming out any more than it already has. So I went and already implemented these strategies with the LinkedIn and the Apache. I have not done that with the GDX, and if you're not familiar with GDX, GDX is the gold miners index for the junior miners, so the smaller guys, not really the big guys. I guess I'm causing a little bit of confusion with that, with the break even and whatnot. I could have said a couple of things. I didn't mean calls on here. The reason why our max loss is it only goes down to 0, that is because we're not worried about that upside, because our short call is defined by our long call. And so our break even is when you take the short put minus the credit received. So you subtract the short put minus that strike of the short put, and that's where your break even is. And I usually look to cover this when we are looking at a 2 times what the credit received was. for the short straddle on the screen, what's your market assumptions? Well, on this one, you know, if you watch any of my daily market commentaries, right now, just with the economic data coming out, other than the Philly Fed and the Richmond Fed index, manufacturing indexes that came out just recently, those showed a glimmer of hope, I guess, or showed a silver lining in the overall economy here in the United States. But I think the global economies are not doing very well. So for me, I am bearish the overall market, and in that regard, I would be somewhat bullish in gold here. So that's why this would fit my market assumption. And with LinkedIn, I think LinkedIn's gotten beat up, but I think that LinkedIn, of all those social media sites, they do pretty well, because people who are really looking for jobs are willing to pay for more exposure on LinkedIn. So I think that they have a pretty good monetization set up there. And so, you know, I like LinkedIn. I think it's gotten a little bit overbeaten up, but you know, a lot of people say that LinkedIn's kind of passe because the unemployment rate's below 5% and everybody's got a job. Well, you know, they don't tell you with that number that that the job market really isn't that good. There's a lot of those people that had full-time jobs that are now working as part-time workers. They're called involuntarily employed, because at the end of the day, they got to put food on the table. So they're willing to go work at Home Depot, at Hardee's, or McDonald's, or something like that, because, you know, they need to earn a living. And so they are employed, so they fall off of that number, and that number is a little bit skewed. The other side of it is they have something called the discouraged worker, where they have no longer gone out and sought out unemployment insurance, and therefore they aren't considered unemployed. But that's all on a completely different thing too. So I am bullish LinkedIn for those reasons. Yeah, again, G, you and I could probably talk for hours about this whole thing. Okay, so what's the difference between the straddle and the broken wing butterfly? The broken wing butterfly, if you're thinking about like a broken wing iron butterfly, a butterfly is usually either all calls or all puts. And a broken wing put butterfly, or sorry, a broken wing iron butterfly would be defining this risk somewhere down in here. So you wouldn't necessarily go the equal distance here. So in this regard, you know, I sold the 27 straddle, bought the 29 calls to get my total credit at $2. So as you can see on this chart here, or on this analyze page, that we have no risk to the upside, and actually we have about 5 cents profit if the market rallies up and above. If the market were to trade down, our break even is subtracting that $2 credit from our short put, and that gives us, you know, $24.95. So if you could draw a line, you would see that that's 5 cents below the 25 line there. So, and it also shows that our risk is continuing to the downside all the way till the junior gold miners go to zero. A butterfly is either all calls or all puts. If you're doing an iron butterfly, then that is a call spread with a put spread. Just like an iron condor is out of the money call, out of the money put. Iron butterfly is a straddle with defined risk. An iron condor is a strangle with defined risk. But otherwise, some people will say butterfly and mean the iron butterfly, but the correct is iron on that. That means there's calls and puts, and it would be a put butterfly or a call butterfly. And that's where you're doing an in the money call to at the money calls, and then an out of the money call for defining that risk. Depending on which way you're doing it, I suppose, from a short end or a long end. But so that would be the difference. So maybe we would buy, to make this a broken wing iron butterfly, maybe buy the 24 puts or something like that. We still would have a little bit of risk, but it would define it here. So it would look like a line going, I don't know if I can, this and then up. That would be the iron butterfly, but we aren't broken wing iron butterflies, but we're not going to do that one right now. So anyway, moving on. So that's kind of what the risk looks like. And, you know, I always talk about trying to implement these types of strategies when you're selling premium right around this, somewhere between 45 to 35 days. I wasn't able to do this. I was picking the shorter duration because I would like to take it rather than going out to 50 some odd days. I opted for the inside because I want to take advantage of this theta decay. Anytime you're selling premium, you want to take advantage of this slope here rather than this slope out here. This is your theta, or your time decay, happening a little bit more slowly. And then once you get inside of here, you can see it really starts to speed up. So I picked right here around the 23 days because I did it a couple days ago, probably. I think it's 21 days-ish now or something. But so I'm trying to take advantage of this, and I would really like to be out with 7 days. Yes, it does speed up here, but there's a lot of other things that go on with the options. There's gamma risk, which means once your gamma increases, that affects your deltas more rapidly on any dollar move. So I just like to stay out of this and keep it clean, if that makes sense. So that's my target. You know, if it's at a loser and maybe the market's rallied above my my long call, then I'll probably leave that on, hoping that maybe I get a bit of a downdraft and that market comes down for me. So, but if it's starting to look like, you know, it's going to go down and test my break even on the downside, and I'm right around this 7 days, probably going to close that out rather quickly, and take whatever I can for it. So keep that in mind, you know, because I wouldn't want it to turn into a loser. And if it's on the upper band and I've already gone and breached my defined risk, then I'll leave it on just in the hopes that I will have it come back down for me. Can we use this approach on index options that are weekly? Absolutely, you can. Absolutely, you can. I usually stay in the monthlies, but you know, if there is enough volume and open interest in those weeklies, that would be the way that I would look at it. If there's not very much open interest and volume in those weeklies, then I would probably default to the monthlies. Just because once you start adding more legs to these different strategies, if there's not a lot of volume and open interest in there, just means there's not a lot of players in there, and those players that are in there are demanding a wider bid ask. So if you have to give up more edge on each of those legs of this strategy, then that eats into your profits. You know, ultimately we would love to have like 1 or 2 tick wide markets, which goes back to the indexed options. Then, you know, those usually have a lot tighter bid ask. And that would work very well for those. So you can definitely do that. So it works with all of them. I usually stick to the monthlies and, you know, look at maybe hopefully only having this on for maybe 2 or 3 weeks. Remember, anytime you have like a straddle and you're at the money, those options take a little bit more time to decay than the ones that are like the strangles or something like that, where they're further away from at the money. But we can gamma hedge differently since we can, yes, you can gamma hedge differently. But, you know, again, this could be a 2 or 3 hour webinar at that point. And, you know, when we're doing this strategy, because of the defined nature of this, going into deltas, which I'll get into here in a minute when I pull up the strategy, now that I'm thinking about it. So let's get into the platform here, and let's just look at this. So because of the defined risk strategy of this, you know, if we were to sell the at the money, let's just go back to that. I mean, we could do it on CMG, but we're dealing with big numbers there, and doing the math in my head on the fly might get a little wanky. So let's just look at GDX, the junior gold miners. And so for instance, it's trading right around 97 again. If we were to, first steps we do is sell the straddle, which is the at the money. You could, this is the closest to, so let's just go with that. So we're doing the 27 straddle, and of course I've got the other one loaded in there already. 27 straddle. I usually just build everything out. I don't usually go up here and pick the thing. I always stay at the single because I like to build it out. So if you're doing this on toss, you click the call or the put, and then when you go to click the other one, you have to hold down the control button and click on it, and then that loads it in. So as you can see here, it pulls up, we got $2.60. So I would look just down the option chain and kind of figure out where I could buy that and still have it equal distance. You know, I mean, if I go out to the 29.5s, you know, then I've got risk on the table, right? Because then we have 50 cents from this. It's going to give us $2.05, so I've got about 45 cents in risk. But if I pick the 29s and go control buy, you get $2.50. One thing with this strategy, because it's custom, you have to play around with your numbers. Pick your quantities that you're used to, and also, you know, full disclosure, I do not have GDX in my portfolio. So go down to, you know, 1 or 2, whatever you're comfortable with, and that's how you build that out. So that 60 cents we paid to define the risk makes it so we have no risk to the upside. But one thing you have to know is your deltas, right? So if you are short deltas, then you are short that underlying, right? So when I'm selling the calls, I'm creating negative deltas. And when I'm, buying or selling these puts, creating positive deltas, it creates the opposite. So I am overall short deltas by doing that. But then when I go and buy these calls to define my risk, I'm getting long these deltas. So when you add up all your deltas with this strategy, you are always going to be overall long deltas, which is another caveat to your idea that you are bullish the market. If you have long deltas, you're bullish that underlying. If you have short deltas, you are bearish that underlying. Whether you wanted to build it that way or not, that is what the deltas are telling you. If you have long deltas, you want that market to go up. If you are short deltas, you want that market to go down. So on this, we would be long deltas. I do not, great question, Trevor. Do I always pick like the 29 delta? No. The way I define it is simply, you have to do the math and play around with these numbers to find out, you know, you could have picked the 28s and made it where you have no risk to the upside and you wanted to collect a little bit more than 5 cents if you're more bullish, right? In an IRA. I don't even know if that would even work. It might not. I'd have to do the math on it, but this works to where there's no risk to the upside. So let's just see. So if we went to the 28.5, I can figure that out rather quickly. Go like that, $1.85. So yeah, you would get 30. So it's $1.85. The difference between these is $1.50. So if it goes above 28.50, then you would get to keep that 35 cents. No questions asked. If it goes and stays above there, you know, you have risk if it comes back down at expiration, and or near expiration it goes below, but so you would be able to keep that 35 cents if it keeps rallying. So if you're really more bullish on this, wanting to collect the premium, then you could define it by going in a little bit further and know that you had no risk of the upside and you were going to be able to keep that. So you can play it that way too. I usually just go a little bit further out because I want to hopefully collect the entire premium and nail the number at the end of the day. Another thing that I was talking about where we're bullish, not only because we have long deltas on this strategy, but there's always, these deltas tell you the probabilities also, right? So a 29 delta is the probability that this is going to be 29% approximately. You know, I know it's not exact, but you know, being a floor guy, we just always looked at the probability or the deltas as the probabilities. It's give or take a couple percentage points, but then we're splitting hairs. But for simplicity reason, we could do this in our head as well. You know, 29 delta, that's a 29% probability that I will be in the money at expiration. But these deltas also tell you something else. Anytime you're doing an option strategy, almost from go, you're losing money on option strategies, it seems like. And that's because there's a whole myriad of things going on with them. But the probabilities are the probabilities. It's just like, you know, you hear somebody talking about cards. The probabilities of getting an ace are the probabilities of getting an ace. It doesn't matter. It's the same with this. These are the probabilities. And probabilities, let's say, of it, these 29, or well, I switched it to 28 and a half, so let's go back to my original 29s. The probability of these 29 calls being out of the money is 70%, right? The probability of it being in the money is around 30%. But the probability of the market going up and touching these 29s is double the delta. So you can write that down. Probability of touch of the market coming up and testing me is double your delta. So that means there is about a 60% probability that the gold miners will go up and test that 29 strike during the next 21 days. It's not saying when it's going to happen, but it will likely happen sometime in the next 21 days. So we would rather it come up and test this break even, if you will, rather than go down and test this break even, because we're going to sweat a little bit more there than we will here. So that's why you want to also have that bullish assumption, because you would rather have it come up, test, and then come back down that way. So that's why you're market neutral. Ultimately, over the course of 21 days, you think gold miners are going to stay pretty close to here, or, you know, lean towards the upside. I'm a little bit more bullish because I'd rather be tested here than tested here too. So that's another reason for that, aside from the obvious year-long deltas. Yeah, and then can I put this in the Analyze tab? So let's look at Analyze Trade, and it's giving me two of them. So let me delete one of these. So as you can see here, and as a matter of fact, it really doesn't matter. It's just going to get my dollars doubled. But as you can see, the deltas are positive. We're long 29 deltas because of this strategy, the way we've built it out. So that makes us bullish. I mean, even if I'm bearish GDX, if I build this strategy, this is telling me, no, you're not bearish, you're bullish. And that's, you know, you got to take that for what it's worth. And then your buying power effect is 6,000. 600. You know, if we didn't have that defined risk to the upside, it would be dramatically more than that. Do you stage orders to exit your trades at a profit target or maximum loss? Yes, great question, TJ. My max loss on this, if I'm doing this for $2, my max loss out is when I reach $4 on this. So that's when I'm going to get out 2 times the credit received. So it would be, $4. I mean, some people could argue that it would really be 3 times because of the $2 credit, but I just look at it as $2 credit, $4 loss on this. And then my max profit on this, because I've got that defined risk to the upside, sometimes, if my assumption changes a little bit, I might go for $1, usually like 50%. But with this one, if it's trending upwards for me, I'm going to just look to leave it on to about that 7 days. And that's when I'm going to look to take it off. I'm kind of more of a time with this one. If I'm right, if I'm wrong, 2 times the max loss. But somewhere between 50 and 75% of the total credit received is where I'm looking to get out of this, because you're never going to get 100% of that credit without taking it to the bitter end. So a good strategy anytime you're collecting a credit, shoot for 50% of max profit. If I'm just doing a naked straddle without the defined risk to the upside, I'm going to be a little quicker on the trigger finger because it takes a lot longer to decay, like I said. So if I can get the volatility to come out of these, and that's another thing, as you can see, I picked something with a high implied volatility percent, and you can do this under your watch list. You go to the gears and pull up customization and pull that in there. It's the first thing I look at. I don't even look at the stocks, you guys. I strictly look over here and go down the list, find something that doesn't have earnings in them, and go from the highest implied volatility and try and find something to put on that I like. So, that's why I picked Apache there. It was the first one down. Lulu has earnings in it. Seadrill, it's a $3 stock now. It's really not going to give you that much bang for your buck on the credits. Google, it moves around a lot, so I usually like to have defined risk with Google. So that one, kicked that one out. Excuse me. And then basically the next one down was LinkedIn. So I just go down the list, straight down, and save the gold miners for what I'd probably implement on Monday when we come back to put another strategy in my account. So I probably will be doing GDX on Monday, just so you guys know. I already have LinkedIn. I already have Apache. I practice what I preach. It's if I see the good setup, I'm going to do it. So gold miners, the junior gold miners, I'll look to do on Monday if it's still fitting these parameters. But the reason why you don't want to do it when there's low implied volatility, because as that volatility expands, for one, it doesn't allow your premiums to decay, because volatility holds up that theta decay that we're really looking for. We want theta to come out. We want the time decay to come out of these fast. And you don't get that when premiums get pumped up through volatility expansion. We want the volatility to collapse on these right away, which allows all that theta to come out quickly, and then we exit the trade. So anytime you're doing a credit spread, you need to have somewhere above a 50%, 50 IV percent. And if you're on toss, if you go to the trade page, close all these out. Right here, current IV percentile. And what that is on the chart, as you can see, it's this blue line, historical implied, or historical volatility is in purple. I only really look at the blue, but that gives you your 50. It's not 50 over here necessarily. What it's telling you is implied volatility for this underlying is in the upper 50% of the last 52 weeks. Okay, so in a sense, yeah, the way, the dirty way to figure it out and probably very close to the way TOS figures it out, is you take where implied volatility is right now. So let's just say it's at 55 for probably math at the end of the day. So you have a numerator and a denominator on a division table, right? The numerator on the top, you take where implied volatility percent is right now, 55, and you subtract that from the low, which is 1. So 54 on the top. So 55 minus 1.5 or 2. So you could say, let's just say 2 for math purposes. So on the numerator we have 53. 55 minus 2 equals 53. And then on the denominator, on the underside of the problem, you take the high, where it was on the high, which is 97%, divide that by, take 97, subtract that by 2, so you got 53 divided by 95. So that's where they come up with implied volatility percent. It gives you where it is now into relation of where it's been over the past 52 weeks. Does that make sense for everybody? Where it's traded, on the numerator, where it's trading now, minus the low, and you divide that by where the high minus the low is, and that gives you your percent. Would you look at the trend of percent IV, make a judgment of future volatility expansions or contractions? Absolutely. If it's at 100%, I'm going to assume it's going to go down. Doesn't mean that if you are at 100%, it can stay at 100%, right? Because the way this math comes out, if the market right now is at its high, if it upticks another percentage point, it's still at its 52-week high. So, you have that against you, but at the end of the day, we really want to see the volatility come out, and if it is at a high, it usually doesn't stay at that high for a very long extended period of time. As you can see, it usually will come down. And you can assume that when you're heading into a binary event, for instance, with who just had earnings? Somebody, what was it? KB Homes? Was it KB Homes that just had? It was KB Homes just had earnings. They're one of the last ones to announce. So as you can see, I mean, usually going into the binary event, KB Homes has been all over the place because that has to do with the housing market, I guess. So it might not have been that good of an example. Let's look at something else. Let's just look at Apple. So everybody knows Apple. So you can see when you're going into binary events, this is, ratcheting up as you're entering those binary events. Of course, so this is actually another good example. So this was that August spike, when everybody was freaking out off the mini flash crash, if you will. So volatility spiked for everything. But, it's kind of like in diving, and it's a good thing to know this math because it's going for the next several months, add this high implied volatility mark into the equation. So it's going to look like implied volatility percent is lower than where it really is in my eyes. So if you, like in diving, discount that high spike, then it's usually only on the high end. You don't usually get low spikes that are unreasonable. But you could discount that and say that maybe this is the high at 72% and add that in to your denominator part of the equation where you take the 72 minus the low on the denominator. And that will give you a higher implied volatility percent. So that's why it's good to know that math because, this is an extreme outlier and that doesn't happen that often. One could argue with the algos and everything else it could happen more often, but still may only happen once a year, and to plan on something like that is a little bit crazy in my eyes. But so sometimes, especially if I'm looking at something that everything else sets up really nicely for it, and there's a crazy spike in it, I'll discount that. Excuse me, I got a tickle in my throat. So, you could do that with Apple. It's still going to be, well below my parameters on ID percent, but something like that you could. But generally speaking, with going into binary events, and of course I can't find any example where that's showing it all the time. It's always looking like it's happening. That's those August, but heading into earnings is usually where you're going to get that happening. So, Kathy, I just did a webinar because we've had such low implied volatility percent for an extended period of time. We've just really gotten through the earnings cycle. So a lot of these implied volatilities are way down. That I am looking for expansion in implied volatility. So I'm looking at I was looking at doing a lot of earnings plays, setups using calendars where I'm short the front month, long the back month, and trying to play that volatility expansion with my long call or my long put. So as volatility expands, the premiums expand. Another thing with this being important to have high implied volatility is when those premiums are pumped up, especially at the monies, it allows you to get further away. You collect more premium for that straddle, and it allows you to get further away on your defined risk side, which also in turn gives you a lower break even on the downside if the market were to trade down that way. So keep that in mind also. Okay, so that's why it's important to have those implied volatility, especially when you are trading something like, like that Apple, Apple's probability of volatility expanding on us, since it's at 11%, is pretty high. So this would be something where you would look to, I'm long some calls in Apple actually, but that's more of a delta adjustment. I don't like to add, I don't like to pay for strategies that much, but when you're only having low implied volatility, you don't have a whole lot of choice, because if I were to sell a put, say an Apple, and the market rallies but implied volatility explodes, then I could be directionally right and still lose money on those. So that was more of a delta adjustment, because I'm short deltas in my overall portfolio. So I talked about that in a market commentary. So I threw that in there. But on delta adjustment. So that's why it's also important to watch those daily market commentaries, guys. I don't know how many of you guys take advantage of that, but I talk about on a daily basis, how I'm adjusting my portfolio for different market conditions. So, if you get short over, you have a market assumption, but you need protection. You can buy something that's out of the money for relatively cheap, get your delta adjustment and participate a little bit on the upside, albeit you're getting hurt on your overall portfolio. It's a way to semi-hedge your portfolio so you don't have complete exposure to the upside, which was why I did that Apple thing there, but that's completely different. How do we get the daily market commentaries? Great question. You can go to Pro Trader Strategy, and if you're signed up for my thing, I think they send them off to everybody. And if you follow me on Twitter, I will retweet those out a lot when they come out. We blast them out. I think they come out around, try and get them out around before noon Eastern, if at all possible. But I usually cover my trades in the morning, look at setups. The only thing that I don't implement in the morning, and that's the earnings trades. When there's an earnings trade coming up, I try to implement that in the last hour or so. And there's actually a whole webinar on earnings trades where I'm using like weeklies or something like that. It's like a one-day event, because that's when I'm looking. One thing that I love about earnings is, I know that implied volatility is coming out, and it's coming out fast. So within the next day or two, like you can see here with Apple, the next day or two, this implied volatility was high, but the next couple of days, yeah, I mean, it just completely fell out of bed. And I'm only going to be in that trade for one day. So I'm trying to take advantage of that implied volatility contraction, which allows that data that's been held up for so long all of a sudden come out. So, that's when you know volatility is going down. It rarely, if ever, expands unless something really crazy happens, like the CEO says something really silly, expands after that earnings event. Because everything that was unknown is now known. So volatility comes out. But that's about all I've got. Does anybody else have any questions on anything else? Or I usually ask, if you want me to look at a couple of stocks real quick. We're running low on time. But if you want to throw out a couple of ideas, I can take a look at them and we kind of build one out real quick. Any takers? Other than Apple. I mean, it's got, if you can see this list over here, it would probably be from these. There's not a whole lot of them. And I don't have every one of them. As a matter of fact, I'm always interested in doing this because people have some stocks that actually have a lot of implied volatility, have a lot of volume and open interest that I don't usually look at too. So it's kind of makes it a little bit more fun. What's my favorite earnings setup? I usually do either I almost always do defined risk, but I usually have an assumption, but it would be along the lines of iron condors or short call spreads, short put spreads. I'm always looking to collect premium, never looking to try and pay for premium in that, because I could be directionally right and still not make money. So as we can see, General Mills immediately 17% IV percent. I'd kick that one to the curb. Microsoft, I think, has low 16. As a matter of fact, as you can see, this was one of those earnings setups I just put on. So I sold the shorter dated ones, and what I can do is roll these short ones out, collect more premium, and try and get these for free. But that's a different one altogether. Facebook, I know I don't have anything in. So Facebook, again, so we're going to be struggling to find something with high implied volatility. Let me shut that grid. FCX report. So $10. I don't know if we'd get the premium again. See, it's 32. I would, I will bend the rules a little bit and go like if it were 48 or 47. But that's the first thing I look at before I do any kind of strategy is applied volatility percent on that. So those really wouldn't work. We could look at something like let's just look at potash because it's right there. And we'll try and do it real quick. Got a couple of minutes. So, I'm probably going to pick this one. Potash usually has pretty good tight markets. As you can see, they're only 3 cents, 2 cents wide. So potash has good markets. What's the implied? 63. So that's good. It's trading around 17. So I'm going to pick the 17 strike. So I'm going to sell this call, sell 17s. I didn't do it the first time. So there's my straddle, and I collected $1.28. So hopefully I can go to the 18th strike and pay less than 28 cents, and I can. So my defined risk to the upside, IRA gods will let us play, and no risk to the upside in potash, and potash has been beaten up, and we could still collect 7 cents if it does end up rallying. So I wouldn't really worry about potash a ton going to the downside. they're obviously dependent on the price of commodities, like the grains. If grain prices are really low, then farmers aren't going to spend money on fertilizer, because why produce more crops and send the prices even lower and have more expenditures and less profit? So why not just have a crummy crop and watch prices go up? But that is why potash has been beat up, is because grain prices are really low. So that would work. So that's how I do it. I figure out how much my total credit is, and then that gives me the idea as to how much I can spend per dollar. Pretty simple, really, right? All right, well, I want to thank you guys all. I mean, I know it's Friday, we had the day off, and you guys stuck around to do this, but this, a couple of people were asking about the daily market commentaries with the premium membership. You get my daily market commentaries where I talk about everything from economic, geopolitical. I talk about the numbers and how I think that they are going to be affecting the markets, and that's even global numbers. I talked to you guys about what German GDP, manufacturing numbers and stuff like that, and whether or not the economies look to be expanding or contracting. And then I talk about when I put a trade on, when I defend it, how I've defended it, why I've defended it, and when I take them off. I don't do a whole lot of talking about the winning trades, because those are the easy ones. The ones that we spend the most time as options traders dealing with are the ones that need to be defended. So I talk about how I'm doing that, when I'm doing that, and why. And then you also get the lesson videos where I have many of the option strategies that I do in these webinars, but they're more like 10, 15-minute videos where I just go over the basics and a little bit about the rules that I'm going into. So they're more like refreshers. So you don't necessarily have to watch the entire trading workshop or this webinar, which would last an hour, to find your answer that you were looking for. But you also get access to the trading workshop. So you get a special offer. This is in the chat log. Should be a link in the chat log there that shows a link to this. Otherwise, you can go to I don't know why that slide was in there. You can also go to Pro Trading Strategies /Wolfman special options trading offer. Actually, you can just go in there and toy around and find it. Or you can reach out to us at 310-598-6677, or you can email us at trading@protraderstrategies.com. Sorry, I don't know why that's off of there. There's something in there in black that I wrote accidentally. And in future webinars, we're going to be drilling down on other options components and how to trade them, trades I find and where I find them appropriate. So keep your eyes out for that too. One thing I was going to say, that if you guys are signed up as a member and want to reach out to me on something, like you have a strategy that has gone against you guys and you want to know what my rules are on how to defend that, what I would do in your given situation, I am more than happy to tell you what I would do in that particular situation. I can't tell you what I think you guys should do, because I don't know what's in your portfolio. I talked about that. I don't know your risk parameters, and the governing bodies that be say that we can't do that. So and that's appropriate. I can't tell somebody a strategy that I think they should, or an underlying that I think they should put in their portfolios, because I don't know your risk parameters, and it's for your own benefit. So if anybody tells you that you need to do the trade that they do, beware, because they don't know you. So that is what it is. But I will be happy to tell you how I would do it and what I follow in order to get that done. What is the name of your charting? I don't have a charting package. I just, I do look at charts and I tell you what I'm seeing on the charts, but I don't really have a charting package. I don't have any algos or anything else that does a scanner or anything like that. My scanner is I put it over on watch list, figure it out from the IV percent, whether or not I'm going to buy it or sell it. Was there a charting package on that last one? Or maybe on the website there's a charting package. Is that what it is? I don't have a charting package other than, that's Thinkorswim. So like if you guys want to join Thinkorswim, tell them that, I sent you. That helps us out. If you sign up with TD Ameritrade and you tell them, where you heard about them and why you want to use them. But where your strikes were, I see. It's Thinkorswim software. Yeah. So I just use Thinkorswim software, but it does help if you guys tell them, hey, Wolfman sent me and I'd like to sign up. So that does help us out. But, I'm not pushing Thinkorswim. There's Ninja Trader. There's some other things. I'm not financially reimbursed by Thinkorswim. I just, I know their software. I knew the guys that built it and still work there. So, there were guys from the floor. So I just kind of followed that. So, I can't speak on anybody else's platform because really I haven't used very many outside of Thinkorswim and the ones that we would use on the floor, which was like Cunningham and TT Trader. That's usually for the Board of Trade stuff. So that's about it, you guys. I appreciate you guys sticking around a few extra minutes and chatting it up with me. I hope you guys all have a great weekend. And if you can't take that, take it easy. I got you, RJ. Thanks. RJ, basically anything that is not good for an IRA is non-defined risk. If you can define the risk, then usually it will work in the IRA. But I don't have a section. Maybe that's something we should do. So, we appreciate your feedback on that because that could be a good section where I just go over IRA options trades that are